All right, let's tackle a topic that sounds way more complicated than it needs to be. Capital gains in Canada. We've dug into the official Canada Revenue Agency guide, the really dense one, and we've boiled it all down into the simple explainer. Let's jump in.
So you did it. You sold some stocks, maybe that family cottage, or even cashed in on some crypto. You made a profit, which is awesome. But then comes that little voice in your head going, uh-oh, what am I going to owe in taxes? If that's you, you're in the right place. We're going to break it all down.
Okay, first things first. Before we even get to the gain part, we need to understand what we're even talking about. It all starts with something the government calls capital property. This is the foundation for, well, everything else.
So what is capital property? Honestly, it's pretty simple. It's basically anything you buy hoping to make money from it, either because it grows in value or because it generates income. The usual suspects: stocks, bonds, mutual funds, but also physical things like a rental property or a cottage that's not your main home. This is the bucket of stuff that can trigger a capital gain.
Next term you'll see is proceeds of disposition. Sounds super official, right? All it means is the sale price. That's it. It's the top line number, the total amount of cash you got or are going to get for selling your asset. Now this one is maybe the most important number you need to keep track of, your adjusted cost base, or ACB. And listen up, because this isn't just what you paid for the thing. It also includes all the extra costs you paid to get it, like brokerage fees or legal costs. This is why keeping good records is so important. A higher ACB means a lower capital gain.
So see, when you put all those pieces together, the formula is actually really straightforward. You take your sale price, you subtract your full cost base, the ACB, and then you subtract any costs you had to pay to sell it. What's left over? That's your capital gain. Simple as that.
Okay, so you've done the math, and you've got your capital gain number. Now what? Well, here comes the single most important part of this whole thing in Canada. I like to call it the magic number because it's what determines how much of that gain you actually get taxed on. Let's just walk through an example with a nice, easy number. Imagine your total capital gain for the year is $10,000. So, does that mean you have to pay tax on that entire 10 grand?
The answer is no, not even close. And this is the best part about how capital gains work here. In Canada, we have something called an inclusion rate, which means only a fraction of your gain actually counts as taxable income. And for 2024, that magic number is 50%. So on that $10,000 gain, only half of it, $5,000, is considered your taxable capital gain. That $5,000 gets added to your other income for the year, like your salary, and then you pay tax on it. The other $5,000, it's completely tax-free. Pretty great, right? All right, we understand the math, but where do you actually report all this? Let's talk about the paperwork. Don't worry, it's really just one main form you need to get familiar with. Everything, and I mean everything, related to capital gains and losses goes onto a form called Schedule 3. This form just gets attached to your main T1 tax return. It's where you list out all your sales for the year. And here's a key point. Even if your gain is totally exempt from tax, you still have to report the sale on this form. Now, when you look at the 2024 version of Schedule 3, you might notice something new. It's split into 2 periods. Before you panic, for most people selling stocks or mutual funds, this doesn't change a thing. The only reason for this split is to handle a change to a very specific tax break for owners of certain farms, fishing properties, or small businesses. So unless that's you, just carry on as usual. So far we've talked about what you owe. Now for the really fun part. How do you legally reduce that tax bill, or maybe even wipe it out completely? Let's look at the 2 biggest tax-saving tools you have. On one hand, you have the big one most Canadians know and love, the principal residence exemption. In short, when you sell the home you actually live in, that profit is usually 100% tax-free. Just remember, you have to report the sale to claim it. Then, on the other hand, you have the more specialized lifetime capital gains exemption. This is a huge benefit for people selling qualified small business shares or farm and fishing properties, letting them earn over $1 million in gains tax-free over their lifetime.
Okay, but let's be real. Investments don't always go up. What happens when you sell something for a loss? Well, the good news is that those losses can be surprisingly valuable come tax time.
So here's how they work. The number 1 rule is that you can't use a capital loss to lower the tax you pay on your salary. But you absolutely can use it to cancel out your capital gains. If you have more losses than gains in a year, you get what's called a net capital loss. You can then take that loss and apply it to gains you had in the last 3 years, or you can carry it forward to use against any future gains, pretty much forever.
Now, there's one big catch you need to be aware of. The CRA is very strict about this. You generally cannot claim a loss on what's called personal use property. You know, things that naturally go down in value just by you using them, like your car or your boat. So, sorry, you can't write off that loss when you sell your old sedan.
Okay, let's wrap this up. If you only remember a few things, make it these 4. 1. A gain is just your sale price minus your total cost to buy and sell. 2. Remember that magic 50% rule. Only half of your gain gets taxed. 3. Your main home gets special treatment, but you gotta report the sale. And finally, and maybe most importantly, keep good records. Your ACB is your best friend when it comes to lowering your tax bill.
And there you have it. We've demystified the core rules of capital gains in Canada. They're not so scary once you break them down. So the real question now is, knowing all of this, how are you going to plan your investments for the future? I hope this helps.